You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, good morning, Jim. Always look to us getting together on Fridays.
China had the hottest stock market in the world in the past year. It gained over 100%, but not such happy times over the last 3 weeks.
Yes, quite disappointing initially, dismaying, and then absolute panic selling. But, you know, as we mentioned it on the way up, there were, back in March, reports about opening, 1.5 million accounts a week, and those new accounts were coming in essentially to buy new issues of stock. And on our technical work on the Shanghai Index, the SSEC, it was generating, as it began to lift off almost a year ago, upside exhaustion readings, which is powerful stuff coming out of an important bottom. And then we had another cluster of upside exhaustion readings, so we looked at it in the same index in 2007 on that bubble top, and there were three big sets, clusters of upside exhaustion readings. And so we were looking for the third one, and it did give one weekly upside exhaustion, but we didn't get a set of them. And that was ironical because there's been stories coming out that new stock investors were buying the stocks, and this were in remote villages, because the Shanghai Index was going to be included in Morgan Stanley's World Index, in which case index funds around the world would have to buy that one to get in line. So this was the big propelling story. So you had an unbelievable event there where you had rural villagers, hanging on what Morgan Stanley was going to do to their stock index. So then it was announced that Morgan Stanley was not at this stage going to include it. So, but anyways, with the one reading we got of upside exhaustion there, I think the top was on June the 12th. And it broke. When you got that kind of a parabolic blow-off going on, and you've got registering these upside exhaustion signals, at least the third set, all you need is a change in momentum or a drop, say a weekly, where you have a lower low than the week before, which got right away. And then the storylines changed instantly, where a few months ago there were some prudent policymakers saying we'd try to cool the bubble down and cool it a bit, and then instantly they swung the other side where they were trying to stop the decline, and they tried a number of things, announced that various pension funds would buy, that the government was going to do this and ease, and then they were going to lower lending requirements, and then another one, they stopped trading on 1,200 stocks. So each of these desperate measures by policymakers announced their own desperation, which, as any trader would do, you'd sell more. But this one historically is going to be important, because these efforts to stem a serious market break are well publicized. They'll never ever be able to get them out of the record, whereas the 1929 crash, the Federal Reserve did ease and was doing everything it could to prevent the crash. And it wasn't until the 1960s that various ambitious econometricians, interventionist economists, still realized that they needed the Federal Reserve System and that it needed to be perfect and pristine. So then they came out with a bunch of stories that the Fed in 1929 to early 30s was deliberately tight, laying the blame on the guys who were running it rather than the fact that the system couldn't handle that kind of speculation. And this is, of course, what we got here. That was similar to Tokyo, the Nikkei, in the end of 1989, similar bubble. Yet on the way up, as I recall, what was it? MITI, M-I-T-I, was the name of their planning agency there, and it was considered the best in, not only the best in the world, but the best in history. And so they were trying to talk the boom down as it was going up, and then the peak was right at the end of '89. And then somewhere around February, I couldn't find the note on it, but I recall they were saying, this is getting hit hard, ease margin requirements. So that's went into a horrendous crash. So this crash and this is the start of a crash in Shanghai historically is extremely important because, as I said, it's well recorded that they tried to stop the deflation. So anyways, it came down to the 200-day moving average. My colleague Ross had done a technical study on that, and once it broke, that was in a harsh bust. That would be the probable support line, and it indeed did turn out to that. So now we've got a rebound target out there. What is it here? Oh, around 4,300 out later in towards the end of July. So this would be just sharp rebound. And it fits in with our model, general model, where the really huge speculations were likely to burn out in May or June and get hit and then turn around. And in the case of the senior indexes in New York, they've been pushed down a little with this as well. Well, a little more than a little. And they could turn around in here, and senior indexes in New York, we've been looking for a final surge into September on that classic discovery that you can have the tail end of a bull market being set in early September. So we'll stay with the models. We're working here, but it's interesting that this 200-day moving average also showed up in the crash in 1929 where it came down to the 200-day. The Nikkei did it as well. And then you look at back in 2000 with the tech bubble in the NASDAQ, the NDX, it came and bounced off of that as well. And then even gold and that big, huge speculation that blew out in January 1980, the correction is the same. So what we have here technically is you have a very similar pattern on the speculative thrust, the hit, and then the collapse. And it doesn't matter what the name is, Dow, 1929, or Nikkei, or gold. So this is stocks ranging from 1929, gold. So it suggests that speculation, a speculative fever like this, it doesn't matter what the name of it is, because everybody says, I got to get in, and then it crashes. So now, let's assume that this rebound could last into late this month, and then turn around. So what we have here also, we also want to look at the credit spreads in the U.S., corporate spreads against treasuries, and in the good times they narrow because everybody's confident, and then in the bad times they widen. Actually, they begin to widen before one could describe it as bad times. So we've been monitoring that, and it's sort of the action here with positiveness on credit spreads narrowing into a May-June window and then starting to turn to widening, which is the bad side. And so we're kind of like in July of 1998, where the spreads were changing to widening, and at that time the whole of the street was playing for narrowing because the central banks in Europe were getting the European community together, and all spreads in Europe would trade at the same level, and that was called convergence. And then the huge hedge fund LTCM was overly long, and they got nailed. And then the same thing in 2007. It was the seasonal turn in credit spread, and then repeated in 2008, and that was, of course, when that high in the early part of 2008 and the stock market on the rebound, then it really had itself. So we would say that the change in the credit spread now is very similar to July of 1998 and of 2007 and 2008, and I don't see anything that would stop spreads from widening, because when you go back through history, all the talk about the central bank, particularly the Federal Reserve, change yields, and they're going to buy bonds and they're going to increase rates. It's all nonsense because they've always been behind the event when you're in wild speculative markets like this. And so we'll just watch and see, because in the 100 years of Federal Reserve history, there's no sign of them ever stopping the reversal to widening credit spreads when a financial party has been on. So why would it be any difference now? So the guys who are talking about whether the Fed is going to increase or leave rates at zero is just not part of the equation. There's no point. They haven't done their homework. So let's just say we are in, we've had the first wave of the storm in Asia, and we're now in the eye of the storm, and then probably September there could be another storm coming through. And I think on equity rallies in North America that haven't been roiled too much, one should be on each rally where individual sectors are looking strong, start to lighten up and just take some of the gambling money off the table, because this thing is one huge gamble.
We'll have more with Bob Hoye right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Bob Hoye. Bob, what's going to happen with the price of crude oil?
Well, it will, a few weeks ago on the rebound up, we had a target at 50. It came down to 50, and it's turning around. But the experience of base crude energy prices, base metals, grains, all that, most of the commodities in the post-bubble world are chronically weak. Sure, you get business cycle considerations come in where you're on an expansion, where we have been, but it sure didn't do much for industrial commodities, because you've had, like, for example, iron ore prices fall to new lows. And the last high was cyclical in 2011. And you've had base metal prices fall to new lows. And you see some of the global spokesmen on commodities, the experts, are still trying to explain away the bear market for commodities that started in 2011. I mean, Jimmy Rogers is out there saying now that, well, the reason why agricultural prices will go up is because the average age of the farmer is aging, and they're going to be retiring. So there'll be fewer farmers, therefore less production. But I guess he's not aware that they've got tractors now in the United States that run off of GPS and are autonomous. They guide themselves in cultivating fields. So I think I'm quite disappointed there. So yeah, and then also in the post-bubble world, the senior currency, which is still the U.S. dollar, becomes, as we like to say, chronically strong against most currencies and most commodities for most of the time. And as I say, it's mainly the business cycle that has the main influence. And this business cycle really didn't move commodities up much. Not since 2011, anyway. So that some commodities are making new lows now is an indication that the global economy is not expanding. And this is absolutely critical because the global debt burden is without precedent. And in order to service that debt, whether it's corporate debt, you have to have income. And even if it's a sovereign debt, government debt of any kind, they have to have tax revenues in order to pay for it. So take a look at Greece. They're not able to do anything. So this is a major juncture in financial history where reality is seriously threatening the dreams of central bankers and policymakers, and it's going to take another major hit to begin to instruct them a little. So here you have it, is they have since, let's go back to June of 2007, when then Bear Stearns, the wire brokerage firm, discovered it was in trouble. And that's, of course, when the Fed started really cranking the money supply. So they haven't stopped. And you've been through a whole credit contraction and the worst financial calamity since the 1930s. And they've continued to print money, speaking electronically. And yet you've got the things coming apart. So we're fortunate to be vertical and participating in this particular period of financial history when 100 years of experiment in intrusion into the markets based on arbitrary notions is running into a brick wall. And that brick wall is manned by Mr. Margin and Mother Nature. These two always win. Just go back to the start of the Federal Reserve when the promoters of the Federal Reserve in 1913 said that it was financial setbacks in the markets that then forced recession. So they have created this genius instrument, the Federal Reserve, that would prevent the setback. There's been 19 recessions since a bubble in 1929, a horrendous crash, and a great contraction. Then you've had the bubble of 2007, which was a classic. You had the Great Recession, and at the moment, if in the equity side, you're looking at the great complacency, and thanks to China, now things are starting to come apart. So, in order to wrap this up, do we want to look at some of the precious metals?
Well, Bob, I was going to say, could we sum up the situation by saying never have so many making so little owed so much to so few?
Oh, thank you, Mr. Churchill. That would be about do it, all right.
We shall fight the bankers on the beaches.
Yeah.
Yes. Well, so what is happening with the precious metals?
Nothing. Last week, when China was under such pressure, you had a day when silver was down something like 7% and gold was down about 1%. So our view on precious metals is that own some gold as an insurance. Don't ever think you're trying to make money on it, because that's just playing currencies, changes. And gold shares are vulnerable to a problem in the big market. That problem in the big market may not be seen until October. So we're not long or short, but we watched the gold-silver ratio, and it got up to 77 the other day in the midst of the pressures. And that is a breakout on the gold-silver chart going up. Now, all we know is that throughout 300 years of history, at least where you've got the data, the gold-silver ratio goes up when you're in a credit contraction, or sometimes it moves a little early. So it's giving a warning. You're getting the warning from widening credit spreads. So, let's just do a few gins and tonics through this summer.
Well, that's always excellent advice, and of course it keeps the malaria away, doesn't it?
Yes.
Because I haven't caught malaria yet, and that's the reason I give.
Yes, you're using them as a preventative.
Bob, thank you very much for chatting with us.
Good to be with you, Jim.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. You can forward questions or comments about the show to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.